Welcome to our DW Business special on what has been possibly the most tumultuous week for US and European banks since the 2008 financial crisis. We will be asking in how far there is substance behind the panic, and we will also have a look at the tightrope that central banks are treading. I'm Marisina in Berlin, and I'm pleased to say I'm joined by Gerald Cohen, Chief Economist at the Kenan Institute of Private Enterprise. Hi, Gerald.
Hi, Marie. It's great to be here.
Gerald, banks are reeling on both sides of the Atlantic right now. Is this a short-term blip or the start of long-term chaos?
My hope, and I would say cautiously optimistic forecast, is that this is more of a short-term blip because of what's going on. Because I think that there's kind of specific set of issues related to the banks and the investment banks that are having problems. That's not to say that this is unexpected, because when the Fed raises interest rates, or when central banks raise interest rates by this much, when monetary policy gets tightened this much, something breaks. Eventually, people have been kind of waiting to see whether they were going to break. There were people that were saying there was going to be no landing, and we were not in that camp. In fact, a week ago, prior to SVB, we doubled down on our recession forecast. And so we saying that something will eventually break, and now something has broken. But we don't think that the extent of what's broken is going to create a repeat of the global financial crisis, and I can kind of get into that as we go further into the discussion.
That sounds good. Yeah, so I'd like to start by talking about something that's broken or something that's breaking in Europe. We saw a major international bank reaching out for financial help here yesterday. Credit Suisse says it's borrowing up to 50 billion euros from Switzerland's central bank to stop it running out of liquidity in the future. The lender's share price lost almost a third of its value on Wednesday after its biggest shareholder, which is Saudi National Bank, said it wouldn't be investing anymore in the company. Now, Gerald, is there or was there a risk that Credit Suisse could break, could collapse?
I mean, the challenge is, and this is what occurs in a financial panic, is that people start looking, or when people start to get nervous, people start looking under the hood in terms of, what's going on in these investment banks, or what's going on in these financial institutions, there tends to be this kind of boom and bust cycle. Everybody's like, oh, great, everything's good, we keep lending the money, and then suddenly people start to take a look again at, what are the high quality assets, what are the low quality assets, and to say, well, in a time of stress, I want to be out of the lower quality assets. These still might be good assets. And that's the challenge in a financial panic, that there are good assets that can be that can decline in value because people just get nervous and want to get out of things that are riskier. I don't know enough about the internals of Credit Suisse to know whether these are good assets or bad assets. I think they are definitely on the riskier side of the assets, and I think that's what the Saudi investment fund decided. These are more risky than we'd like, and decided to pull out, and that caused this vicious cycle in which kind of Credit Suisse had a big decline in its value. Again, whether in time, and this is true during the global financial crisis, the central banks across the world invested in companies, invested in banks. And some of these ended up being very profitable investments. In time, we'll know whether the SNB, if they were doing it in order to retain, for risk reasons, and ultimately these are good assets, or if they were doing it to avoid risk and ultimately they were bad assets. I don't know enough. And I think in some respects, time will tell whether that's the case. What the SNB did is they were trying to, they worried about contagion. And this is also true of what the Treasury and the Fed did with Silicon Valley Bank, which kind of started this process. They said, look, for risk reasons, we're going to control the risk. And what they really had to do was just extend the deposits. They let the bank fail. But in the case of Credit Suisse, I think this SMB decided the bank it shouldn't fail. And so what they need to do is invest in the bank. And again, whether these are just risky assets that are still valuable or risky assets that actually are not valuable remains to be seen.
Okay, so basically a time where the market is really looking for skeletons in the closet, and we don't really know if there are really skeletons in the closet at this point. One thing I'd like to ask you about Credit Suisse. It's a bank from Switzerland, of all places, the banking nation, going through such a tough time. How might this affect other European banks in the European market? We saw other European banks losing stock value yesterday. Again, short-term blip, or is this something that could destabilize the European market for a longer time?
So let me just be clear. I think that if you think about Swiss banks, there are, and this is true in the case in every country. There are strong banks, that are basically in the business of just standard banking, and then there are more risky banks. And Credit Suisse, with its strong investment arm, it was is definitely on the riskier end of banks. So it's important to think about the different risk metrics that you're looking at. It's natural, but again, how long this lasts, it's natural that everybody takes a look and says, wait a second, which banks, where, as you described, where are those, who has skeletons in the closet? And but I think the first reaction of people is to say, wait a second, before we figure that out, maybe I don't want to be involved in those assets unless I know something with certainty. And so I think that's where the kind of contagion occurs. Whether this is limited, whether it's, and this happens with some frequency, people get scared, equity prices go down, asset values go down for some relatively short period of time, and then things bounce back, or whether this is the start of something broader remains to be seen. I think partially I'm cautiously optimistic, and I stress on the optimistic side of the global financial crisis. As I said before, I'm not particularly optimistic on the economic side, but on the global financial side, I'm cautiously optimistic because of the lessons learned from 2008, 2009, and the regulatory regimes that have been put in place, and the mechanisms for central banks, for governments to support their banking systems are now much stronger than they were back then, and that's one of the reasons why I'm cautiously optimistic. And I also think that in general, bank balance sheets are a lot healthier than they were because of these regulations and just generally because of economic conditions. The level of debt for households, the level of debt for corporations is substantially lower on a relative basis. As an economy grows, debt is going to grow, but on a relative basis, they're substantially lower, and even potentially on an absolute basis than they were in 2008, 2009. So you're unlikely to get that contagion effect from debt. So that's why I'm cautiously optimistic. We never can predict it's very hard to predict a recession. It's even harder to predict a financial crisis. And so, that's why I say cautiously optimistic, but I think there's reasons for optimism.
Now, I'd like to move on to one aspect that's come up repeatedly during these financial worries that spread across the Atlantic. You've also mentioned it, rising interest rates. They play a key role in the financial stress banks find themselves in right now. And that's because when interest rates were low, some banks deposited their customer funds into long-term bonds. And these seemed like safe investments at the time, but interest rates have climbed dramatically over the last year. So banks lost money on those bonds. And that isn't necessarily an issue if the banks can sit the problem out and wait until the bonds are repaid. But if a bank is forced to sell bonds, it can only do this with high losses. Now, at the same time, as interest rates have increased and uncertainty around banks has been growing, as we just mentioned, customers have wanted to withdraw money. So the banks have to sell more assets, losing money, just to raise the money needed to make good on withdrawal requests. And as companies get worried about the bank's ability to pay them, that turns into a spiral of fear and a race among customers to withdraw funds. So going off of that, I'd like to ask you, Gerald, are we seeing the first big cracks in the financial sector due to these rising interest rates?
So, as I said, there's always cracks when interest rates rise. The question is how large these cracks are, and your explanation of what happened is a very good one. But I want to add that that this is what banks always do. They borrow, they lend, or they borrow short and lend long. They get this cash that has, with deposits that can be taken away at any moment, and they take that money and lend it in longer dated assets and make the spread. In banks that are, and one of the things that is different, and traditionally is as deposits are growing, banks are increasing or are buying these assets, and they can be long dated treasuries or they could be mortgages, and so they're buying them, they're laddering them as interest rates are rising and falling. But what happens is if you get a concentrated set of deposits, and this is what happened with Silicon Valley Bank during a period of very low interest rates, then much of your risk is concentrated when interest rates rise. And so I think generally banks that are healthy have a diversified level of assets that have interest, both high and low interest rates. Those high interest rates, when interest rates fell, had capital gains, and then when they rise again, those capital gains evaporate, but they may not necessarily be losses. The low interest rate assets, those do become losses, but if you have a diversified portfolio, it evens out, or the losses are relatively small. If you end up with a concentrated portfolio, and I think that's what happened with Silicon Valley Bank, along with hefty deposits that are greater than in 250,000 deposit insurance, that really exacerbates the run on the bank. Mm. So I think the challenge
Would you then say that it's mainly a specific subset of banks that we should be worried about? I mean, we're hearing about Credit Suisse not doing well. That's a very different type of bank than SVB. So how do we put two and two together here?
So I think it's really a question of, potentially different, I think it's the risk profile of those banks. And so I'm not necessarily saying that SVB and Credit Suisse are the same, but I think the issue is that these companies had higher risk profiles to rising interest rates or to general financial stress than other banks that are more, either had kind of more diversified or kind of less risky assets. So I think that it's really the risk bucket that you're thinking about. And in the case of Silicon Valley Bank, it's kind of easy to explain the high interest rate risk bucket. In the case of Credit Suisse, it's a bit harder because of all the activities that they're doing. But effectively, they were both in the high risk bucket, and risk measures indicated that.
So I would like to talk to you a little bit more about central banks and the position that they find themselves in right now. On Thursday, the European Central Bank decided to raise interest rates by 0.5 percentage points, as widely predicted. And that means it's continuing a trend of steep rate hikes despite the instability in financial markets. Now, both the ECB and the US Federal Reserve have been on a mission to rein in inflation caused by supply shortages and government spending during the COVID-19 pandemic. Interest rates have shot up rapidly after years of cheap money, as we mentioned, and that's following the financial crisis. European Central Bank Chief Christine Lagarde said the worries about the banking system hadn't affected the decision to raise rates.
Euro area banking sector is resilient with strong capital and liquidity positions. In any case, our policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed.
So, Gerald, if you can sum it up quickly, do you really think this policy toolkit will be needed?
Again, it's hard to know whether what is, when a blip becomes a financial crisis. But I think what the challenge that you described earlier, the phrase you described earlier in terms of a tightrope, is exactly the right thing. And it looks like markets are saying the Fed may be leaning towards being less aggressive. It partially could be because they've done a lot already. In some respects, we've been expecting a recession based on what they've done. And we felt that the probability of a recession would rise because they were likely to do more. But it is really a tightrope. The inflation data, people are saying a bit more positive. If you look at the guts of the data, I'm less convinced in the US. But I think the Fed it kind of knows that inflation is likely to fall anyway, eventually. And this creates the risks from the financial sector create a greater risk of that happening, or greater probability of that happening. But how central banks are going to handle this, I think what the ECB is saying is that we can raise interest rates and provide liquidity as needed. I think the Fed, if they decide to move forward with interest rate hikes, will kind of do the same. And they've shown that through what they did with Silicon Valley Bank. But it is a tightrope, as you described.
Gerald Cohen, thank you so much for explaining this complicated situation and the clinch that central banks find themselves in.
Thank you. It's great to see you.
Nice to see you too. And thank you for watching the DW Business Special. That's it from us. And you can check out our other business content on the DW News YouTube channel.